Welcome back to the channel, everyone. Today I want to talk about how the SEC is begging retail investors to stop holding, how they've created the most contradictory video because they are petrified of what's currently happening and what will continue to happen in the market if retail continues to hold, or if the shorts don't cover. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, I want to start by talking about this video the SEC just published on their public YouTube channel. I want to talk about each individual way they've contradicted themselves that shows they are absolutely siding with the shorts and begging retail to stop holding. This tweet from Unusual Well says this video is from the official SEC's YouTube page. It seems to trivialise millions of retail investors, seemingly diminishes one of the most important market movements of 2021, and appears to poke fun at millions of average people joining the market. Ouch.
Welcome back, Brad. It's your investment.
I'll take meme stocks. Invest!
Ouch. Your investment, Julie.
I'm gonna do some research first.
Well played, Julie. Well played.
You can do research? Investing is not a game. Always do your research before making an investment decision.
So let's talk about all of the ways the SEC have contradicted themselves. They've painted out retail investors to be these stupid people that invest in stocks wildly on margin, they invest in meme stocks, they believe in guaranteed returns, or they try and ride crypto to the moon. But I want to talk about how hedge funds, the mainstream media, and even the largest of institutions are guilty of using every single one of these on the Investormania board. Citadel, for example, buy stocks on margin. Citadel use a fairly small margin ratio of 8 to 1, which isn't small at all, and some hedge funds or some large institutions, like Goldman, are using leverage ratios in derivative markets of 134 to 1 and above. That means for every £1 of Citadel's money, they borrow an additional £7 from other large institutions to invest in stocks on margin. And in terms of meme stocks, believe it or not, institutions have massively increased their holdings of stocks like AMC and GameStop. Before the meme stock run-up, back in January of 2021, only 50 million shares of AMC were held by institutions, whereas now the number's a lot closer to around 200 million. Institutions have quadrupled their holdings of AMC over the last year and a half because of the meme stock mania. Large hedge funds and institutions invest constantly in the bond market and also the leveraged finance market, which is entirely a market that provides supposedly guaranteed returns. Many large corporations out there list bonds that have a guaranteed return of say 4 or 5% interest each and every year, and these institutions buy up these bonds like no tomorrow. There's also an entire section in the industry for analyst ratings, aka people specifically employed to give stock endorsements or stock investment tips. There's a reason why analysts from every single large institution give buy, neutral or sell ratings for every single stock in the market. Typically that advice isn't necessarily for retail investors, it's to tell other hedge funds and other institutions out there what stocks might be worth investing in. You've also got that scene in The Big Short where Steve Eisman, who was portrayed by Steve Carell, tells his employees to hurry up and short the housing market before every single idiot with a couple $1 million in a fund jumps on this. And therefore FOMO absolutely exists in the hedge fund market as well, because as soon as a large investment or a potentially profitable investment comes around, every single idiot with a couple $1 million in a fund jumps on that investment as well. You've also seen thousands of articles over the last year of the largest of institutions also jumping on the crypto train and investing massively into crypto. You've seen some people like Ken Griffin believe that crypto is a scam, only to then invest in crypto only a few months later. Many of these institutions have hundreds of millions, if not billions of dollars already invested into different cryptocurrencies, and also believe that crypto is going to the moon. And again, you've also got tons of the largest investors that are constantly trying to pivot and trying to time the market, like Michael Burry deciding what different investments to take at different time periods. We've seen Michael Burry shorting stocks like Tesla for most of 2021 when it fell from over $1,000 per share to around $600 per share, but then time the market and close out of his short position before it ran back over $1,000 again. We've also seen Michael Burry, but also more recently Susquehanna selling out of over 75% of their portfolio and going 75% cash to try and time the market and avoid the coming recession. Also guys, if you haven't already, be sure to sign up to Moomoo using the link in the description below to get 5 free stocks worth up to $2,500 each. That's up to $12,500 in free stocks. Moomoo and Futu have also officially announced that Moomoo does not accept payment for order flow, and therefore it's brilliant for buying those AMC shares. Moomoo was also recently given the award of being the best trading platform because it's very easy to use, it's incredibly customizable, and it's entirely commission free. I think this just goes to show the SEC is absolutely siding with the hedge funds on this one and is hoping retail stop holding so that shorts can cover without going bankrupt. As Ryan Riggs said, retail investors everywhere felt a massive slap in the face from the SEC and from Gary Gensler with their latest video. Charles Payne also had a few words to say which I think are very, very important. So let's give it a listen.
Now, you were warned about timing in this commercial, but everyone times the market to various degrees. You also were warned about FOMO, but the essence of investing is not to miss out on the greatest money-making machine in history. Crypto and so-called meme stocks on the board with tulip bulbs. Come on, folks. I don't think they're going to be worthless. Some individual names will be, but these are viable companies. You can debate how valuable they should be. Of course, there's no mention of all the blue chip stocks that have been clobbered over the years. And right now, I don't know if you've seen this market this year, they're getting clobbered once again. Lots of people have been duped and misled about investing, and there's a lot of finger pointing going on. The bottom line, if the SEC really wants to help, really wants to do their job, stop making these insulting videos and do their job. Liz Clayman, over to you.
And I think that's exactly it. Charles Payne has pointed out that obviously the SEC do have the time to do some form of job as they have plenty of time to make these insulting videos. But the fact that they're spending their time making these insulting videos instead of actually investigating what's currently going on with meme stocks just shows that they are absolutely siding with the hedge funds. As Trey says, how about instead of the SEC making fun of meme stocks, they, I don't know, fix the problems that created meme stocks in the first place? Problems like payment for order flow, off-exchange trading, prime brokers, arbitrage, naked shorting or synthetic shorting, derivative leverage or those leverage swaps, and much, much more. But I think the main reason why the SEC is siding with the hedge funds is because they can see what's currently going on in the market and what's currently going on because the shorts haven't yet closed out. The SEC is begging retail investors to stop holding so that shorts can escape because otherwise the market will continue to crash. JP Morgan's CEO, Jamie Dimon, said that it's currently a hurricane. Everyone thinks the Fed can handle this, but the hurricane is right out there, down the road, coming our way. We just don't know if it's a minor one or Superstorm Sandy. We know the market is currently crashing. We know the shorts are holding these over-leveraged short positions and holding onto their over-leveraged long positions, hoping they don't end up being liquidated. Everyone in the hedge fund industry thinks the Fed will come to the rescue and once again bail them out, but we just have to see how big the hurricane ends up being. And even McConnell is saying that it may even take a recession in order to crush inflation. Inflation is obviously spiraling so out of control at the moment, the Fed doesn't have a grip on it and can't rein it in without crashing the economy. And Sven Henrich says if we don't raise rates above neutral, then runaway inflation will cause a recession. But if we raise those rates above neutral, it will crash the equity markets and again likely cause a recession. So you're effectively stuck between a rock and a hard place and they just need to pick their poison. Raising rates typically causes stocks to fall, and obviously if stocks fall and crash massively, it will likely cause a recession. But at the same time, inflation spinning out of control and raising higher and higher will likely also cause a recession as well. But I think really importantly, as Andres says, remember this: even if the Fed does somehow pull back inflation to a 0% growth rate, that still means that prices remain the same. That still means we have to live with the current bizarre prices that are ridiculously high already. To reverse the damage that's done, the Fed basically needs to enter a negative inflation territory to help prices reduce. If inflation is reduced to a 2% rate, that means that gas prices still stay at $6, $7 or $8 per gallon, and everything else continues to stay at the ridiculously high price that it currently is. Therefore, basically the only way out of this isn't just a 2% inflation rate, it's not just a 0% inflation rate. Inflation basically needs to turn negative for prices to fall or the economy to crash. And I think the Bank of England have really shown just how scared they are of the current market by proposing to take over collapsed stablecoin cryptocurrencies due to their systemic risk on the market. It says the Bank of England will take over collapsed stablecoin companies to prevent a cryptocurrency crash hitting financial stability. Basically, the Bank of England will take on this risk from collapsed cryptocurrency companies and prop up these stablecoin markets to avoid any systemic damage to the economy. Clearly, the Bank of England knows the economy is holding on by a thread, and anything, even as minor as it may be, could destroy the economy. It says that stablecoin issuers would be placed into special administration by the bank to protect consumers if they fail. The proposal would mean companies offering stablecoins, cryptocurrencies designed to hold their value, would fall under similar rules as banks and other systemic institutions. Clearly, they know that even small stablecoin companies could end up causing a financial crash due to how much the economy is teetering on the edge. And I think this is why even the SEC is resorting to poking fun and poking abuse at retail investors to basically do anything they can to stop the retail investors from continuing to hold. So guys, be sure to leave a comment down below and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.